By the time 6 weeks later I actually got into the chair, he'd bought the shares of the number 2 or 3 holder and then got into cahoots with the previous CEO. I found myself immediately in a more challenging seat.
Today's guest is Ian Filby, who spent almost 30 years at Alliance Boots before becoming CEO of DFS, where he led the business through private equity ownership under Advent International, a major brand transformation, and a successful IPO on the London Stock Exchange in 2015.
I think it's a discipline that private equity does better, which is cash is king, and you've got to really analyze where you are tying up cash in your business.
Since stepping down as CEO, Ian has moved to the other side of the board table, serving as non-executive chair of Joules and Pendragon, where he navigated activist shareholder pressure and a collapsed takeover bid.
Read the runes. There's certain little clues that your banks will give you that they may not have the appetite that you think they have.
Welcome to Enter the Boardroom, the podcast for boards and board members. I'm your host, Oliver Cummings, CEO of Neural, home to the Enter the Boardroom community, the destination for serving and aspiring board directors. Ian, welcome to Enter the Boardroom.
Thank you, Oliver. I'm delighted to be here.
Ian, can we start by talking about the executive experience you carry into the boardroom? Because you've had almost 40 years in retail, nearly 30 of those at Boots, and then as CEO of DFS through a major transformation. I'm curious to hear, of all those executive experiences, can you pick 3 that have most fundamentally shaped how you now think about what a board should do and what it shouldn't?
Yeah, let me sort of pick on the themes, really. I joined DFS as the second only CEO after the previous guy had been there as the founder owner for 41 years. And I'd helped Advent International do the due diligence on the company, and then they'd invited me to come in and join them as their CEO. And it's more of a theme, but one thing that Advent were brilliant at was recognizing that their expertise was in what I might call the financial acrobatics to create the deal, and also to be very, very focused on having the right KPIs to see that the business was on track with its business plan. What they knew they didn't have the expertise and history on was the operational side of running the business. And it was a great relationship I had with them over a number of years. And it was because they didn't meddle in the operating side of the business. They're good at testing what we were doing and holding up a mirror. So it wasn't a free ride that just let us do it. And that in itself was a valuable experience. But they recognized that myself and the team had literally probably hundreds of years of retail experience as to how to take the plan forward. And that was a great marriage. So I guess that was one particular sort of ongoing experience and theme. The second one I would pick is that unfortunately in life and retail in particular, it's a dynamic situation. The playground changes, and therefore the rules have to change. And we came in 2010 thinking that the recession was over, and the plan was predicated on gentle market recovery. And the first thing that happened after a few months was what you may recall is called the double dip recession. So actually, we hadn't really come out of it, and it carried on for another 3 years. And they enabled me and the team to be nimble around that and recognize that we weren't going to get the market growth. So they recognized that and then were supportive of the evolution of the strategy of the business. And that was obviously going to involve things like potentially M&A and slightly more complex initiatives to grow the business against that difficult backdrop. And then the third theme that I would pick up as another learning over the years is don't let management overpromise to investors. I guess I learned that a little bit in my Boots days when I was obviously a senior executive there. And I saw us run what was called the well-being strategy of Boots. And that promised great forward progress in terms of the company's performance, but translating successful pilot stores to rollout proved to be very problematic and much harder, and therefore we weren't able to deliver the results that we had started promising, assuming that we could recreate the upside of the pilot going forward. Yeah, I think those might be some of the themes that I'd pick up on.
So if I play that back to you, it's don't meddle in the operations, but make sure you test and challenge. Be responsive to the changing dynamics of the playground and be agile in the way that you respond to that. And finally, be wary of letting the executive overpromise to the investors on what they can deliver based on early stage pilots. You start by diving in a bit more to that don't meddle in the operations, but test and challenge. Because for a board member listening to that, that sounds like a very easy and obvious thing to do. What was it that they were doing that made them brilliant at it?
It's a theme that we might come back to vis-a-vis some of your other questions, but the discipline in saying, right, what does the performance have to be in year 1, 2, 3, 5? And therefore, what are the main drivers to get there in terms of the time? One might be gross margin management as an EG. One might be cost control of your store workforce, just giving a couple of exemplars. They may be easy ones. But then making sure that you have a plan and a trajectory, and therefore having, let's call it the one-pager KPI chart that they monitored us on a monthly board meeting basis, was where they were disciplined. So, it was translating the plan into good KPIs and then monitoring them more than, I've had a letter in, or my auntie, and this might be the speak of a board member, I had an auntie went into your shop and she had this terrible experience. You'll always get the anecdote that is sort of counter the general thing. So the real truth is, what are the numbers saying? And it is sometimes difficult, or also as a board member, if we're talking private equity where people haven't been as operational, but if I take more broadly boards where people have been operational, then there is the danger that, they have that one conversation out in the field or that one experience out there. And again, you can drift into management by anecdote rather than management by measurement.
Can you bring to life what those KPIs were? Because again, I feel like many boards will say, well, we have KPIs, but there's night and day between the ones I see doing it really well and the ones that are doing it less well.
Yeah, there is the obvious ones, and I've just mentioned a couple. There's the obvious one of sales as well, which is the brutal one, which you can't ignore. But as an interesting aside, when I was CEO, I ran 2 boards every month. This was with my executive team. We had in effect, what you might call an operating board or a performance board, and then we had in parallel a strategy board. And so one of the things that is important to focus on is, are we doing the development work? Are we making progress on KPIs, on the things that are going to deliver the numbers in 2 years' time? So for instance, for us, although it was counterintuitive, people thought that you weren't going to sell a lot of furniture online. So because in the end, most people wanted to come and sit on the product. However, we I think, got the valuable insight that yes, it was still growing. So it was an important area to focus on, channel to focus on. But more importantly, we realized that people found it easier to browse the range online and then physically come into the store. So dominating the online space meant that it was another form of advertising. So I guess I'm sort of digressing like that because it showed that we knew that in year 2, 3, 4, 5, that the growth of our online business and our share of voice of people who came online going through our website as opposed to others was going to be a portent of future performance. So it's a little bit about measuring the obvious, are you on track to deliver this year's numbers, which is then a portent for next year's usually. But also importantly, are you making progress on those kind of slightly more silent development projects where they're not really delivering the numbers today and therefore can easily be put aside? But if you focus on them, they're going to be giving you your numbers, your growth numbers in year 2, 3, and 4.
Can you tell me more about how you differentiated between what that operating board and what that strategy board did? Was it simply a question of time horizon and who was on those boards? Was it the same groups or different groups?
Yeah, pretty well. I mean, in a smaller business, it's, you have a fairly tight executive team. And it was the same group of people, although you might have, something like the strategy development board, as we called it, might have some external speakers coming in, back on the subject I just touched on, online. Online was, we're now talking sort of 15 years ago, was growing rapidly, but not the same in all markets. And for the reason of the tactile nature of sofas, it didn't have anywhere near the penetration, but was still growing double digit. So, as another aside, we actually created an advisory board of experts in the field who reported into the online director. But we would perhaps once a year bring that advisory board in to make sure that the whole of the exec was understanding if we were making the right progress on those strategic things. But you're right, it's a bit timelines, but it's also understanding the timeframes of the other things coming to fruition. So the operating board was, are we delivering this year's numbers, is absolutely key. And are we delivering them in the right way? Because for some of them, if you're dependent on one line growing that needs to grow the next year, then that's the one you kind of got to keep a focus on. Because you may hit this year's numbers, but you're just giving yourself a real headache for next year.
And was that an easy distinction to keep, or would you have to sort of be quite disciplined about ensuring people were focused on either this year's numbers or the longer term, and reminding them that this is the strategy board, not the operating board, or vice versa?
Inevitably, especially with your ops team that are on the board, because ops guys just can't get out of but we've got fires today, Gov, or boss as I was called. That was a throwback from what I inherited. I never really thought of myself as the boss, but yeah, so you did have to wrestle that. And part of the importance was just running it, and running it with consistent papers and running it with KPIs to say, are we making progress? So, doing a trial in one of the areas to change maybe how the supporting admin function might be a pain in the arse for the operating guys. But when the prize was going to be 2 years down the road or 3 years down the road, you had to hold their feet to the fire of, yeah, I know you're really busy, guys. I know there's stuff going on, but this trial still has to make progress. And I think it was the frequency of meeting and the fact that we were measuring against KPIs that kept us on track. And that was something we did very well over the years that I was there at DFS. I inherited the idea from what I brought in on commercial on boots. So I didn't just invent it out of the blue. It was something that had worked for me when I was running the whole of the commercial side of boots too.
I love it as an idea, and I'm curious if a CEO is listening to this saying, Ian, I think that's what we need. We need to have that split between our operating board and our strategy board for our executive team. What are the things that I need to be thinking about to successfully implement that? What would your guidance be?
Gosh, you're going off again into one of the areas that we might touch on. Well, here, let me answer the question that says, what's the book that I would get all the board to read? And it's actually a book called Future Engage Deliver by Steve Radcliffe. And he was a guy that supported, I think, some quite innovative thinking that me and the commercial team did at Boots. And then we took Steve with us into DFS. And the reason why I go on an aside there is for me, the key thing was that is taking time out for a couple of days on an away day early in the journey of a new executive team. And what we described it as describing a rich granular description of where you're going to in 5 years. So it's a bit of a, big hairy goal type thinking. But I use the word granular description because then it starts enabling you to say, well, okay, if that's with some granularity where we want to be, and you've got to describe it in some program, not just a big goal of, we're going to have 50 stores, you have to start breaking it down. It then gives you a glide path for your strategy development. So you sort of need to do the hard yards there of describing how you translate your future goals and targets into a granular description of what your business will look like then. And then that enables you to start forming. So, well, if we're going to get there, where do we need to have got to next year? So it starts to really, really define your KPIs. So, yeah, I think there's a bit of a process. You don't just go, all right, we're going to run a parallel strategy development board. It has to be born on that more granular understanding of, if you want to hit those ambitions. I remember when I started at DFS, I kept telling the board that we were going to try and go from 23% share to 40% share. Frustrated quite a lot of my board members because they kind of said, well, show me the path, But of course, to a certain extent, it was a goal, and in the goal, it kind of said we're going to have to do a big M&A at some point, And, cutting to the chase, a few years further on, we bought the number 3 player, Sophology, and when I exited, we'd sort of gone from about 23 to high 30s. So we'd nearly got there. But it was the understanding of working back from that goal and what needed to be true. So again, if we keep on that theme, we then did a couple of smaller M&As. We bought Sofa Workshop, we bought Dwell, so that you learned the process of integrating smaller digestible players. And that was sort of part of the journey for potentially acquiring, one of the bigger competitors in the sector.
What was the board input you never got but wish you had?
I'm sure if I could rake through my memory, I could find stuff. I mean, I did find myself in a very tough position, as many small fashion retailers did when I was chairman of Joules, and we experienced all the dramas of freight costs going up, cost of living crisis hitting, Ukraine war, and all of a sudden on a lovely growing successful business, we hit a whole set of bow waves that were hugely challenging. And I just wish as a board, we'd sort of sussed it, but not quite in time, that the bank we had underpinning our business, where we had our borrowings, just did not have the appetite for the sort of risk that needed to be taken as we recovered from those bow waves. And you'll see lots of small little fashion retailers were being hit at the time, and we were not immune to it. And, now I look back, had a relatively rookie, very good CFO, and the pressure on top of managing weekly cash flow crises and doing a refinance seemed to be too big. But now looking back, read the runes. If you there's certain little clues that your banks will give you that they may not have the appetite that you think they have. That would have been one of my big learnings.
What are those runes?
I don't know, but when I reflect back, when they want to underpin the debt with more of the assets within the business, that's probably the clue that they're preparing for the least amount of pain if they decide they want to pull the rug on the business.
For someone sitting on a PLC board right now listening to this who's never worked with a private equity board, what's the one thing they should take back to their next board meeting that you've learned from operating with a private equity board that can also work well in a listed company setting?
Yeah, and interestingly, I was obviously very much running the commercial or business plan really for Boots when KKR came in and took them private. I think the biggest ever FTSE company to be taken private. So I'd sort of learned, people always talk about it, but I think it's a discipline that private equity does better, which is cash is king. And you've got to really analyze where you are tying up cash in your business. So you think if you have divisions or different channels, or maybe even some related businesses, which bits of your cash, let's think, tied up in assets or channels or initiatives, are really delivering the value, and turn that round. How does your strategy really look to optimize the future value of the areas that are creating the value the best? If I took a small example within our strategy, we realized that the belief had been that large stores gave you the big profitable sums, and that it should be a big box argument. And then you realized with online, people were able to see your wide ranges online. They actually wanted a more curated, smaller offering in stores. And in truth, covering the country with more smaller stores rather than a whole bunch of bigger stores meant you could release some cash tied up in the bigger boxes. And in truth, with the lower cash tied up in a smaller box, you got a better return. So this would be a kind of good example where we sort of bucked what had been seen as the knowledge of the furniture industry. Big boxes gave you the big profits. They also just tied up an awful amount of cash, and that there was a more optimum tying up of cash in the size of your stores. And then when you looked at the return versus that, it was an improved return. And I think private equity is very good at being that forensic about how to tie up cash in a business. And that can lead to either M&A acquisitions, because you can see you can get some good synergies, and it can also lead to divestments, so businesses that are just too hungry and the return's going to take too long.
Board relevance doesn't maintain itself. Executive credibility ages. Markets shift. New governance challenges, AI, climate, geopolitics, cyber, can quietly erode even an experienced Ned's standing. Most people don't notice it happening until they're already losing ground. The Enter the Boardroom community keeps you in a growth-oriented environment, with expert events, cross-sector peer debate, and ongoing exposure to the issues shaping board agendas. Visit etb.newroll.com to find out more. Now, after 8 years as CEO, you moved into the chair seat, first at Joules and then at Pendragon. And at Pendragon, you had an intense experience where your largest shareholder, Anders Hedin, increased his stake into the high 20% with what looked like an intention to acquire the business at the best possible value, which obviously presents challenges vis-a-vis other investors' objectives. There was then a collapse bid from Hedin, which left the share price stagnating in the 17 to 19p range, despite the strong financial progress the business had made. And then Palliser, an activist shareholder, came along. Talk us through what that meant for the business.
So we sort of hit a bit of stalemate, really, and that, I think, made us right for somebody like a Palliser to come in and start taking a stake. And recognizing that we were caught in this loop, I think they were then felt there was an urgency to shake things up, as disruptive activists tend to do. And yeah, I think they missed some tricks. I don't think they listened to the fact that we had an appetite to do something, but that some of that something might be being done secretly behind the scenes from a potential buyer who didn't want the approach to be run through the public domain. So, and of course, like a lot of activists. I think the answer is in smart breakups of the business. So there was sort of lots of wise ideas as to different bits of the business we could break up. But of course, with Jefferies, we'd covered all those bases, and we'd come to a very firm conclusion that there wasn't a way of increasing value by just simply selling off, for instance, our SaaS business Pinewood, which we had within our portfolio, which is a standalone business, was pretty valuable, but not enough to create a premium for investors. So it all came to a head with a request really for us to have an EGM and to shake up the board. This was going to be a few weeks before our AGM. And when we felt we were making good progress with a potential buyer for the business. So the solution we opted for was for me to agree that I would announce that I would step down at the AGM and we would look for a successor, and that therefore just stopped disruption and enabled us to continue the good work we were doing with Lithia. And it ended up being a fantastic deal for shareholders. The nature of the deal meant that we only needed 50% of shareholders. So 50% of shareholders were delighted when we, in effect, sold the car business to Lithia and spun off Pinewood and kept the Pendragon listing on the stock market as Pinewood Technologies. And shortly after that all went through, in effect, shareholders got around about 35p return, which was obviously a lot stronger than either the 19 or any other bids that had been put on the table from the previous shareholders. So that's kind of a bit of a thumbnail sketch through the story, Oliver.
Incredible story. Through all of that, what was the hardest conversation you had during that period with the board?
We had a good board. We had a strong management team. We had good advisors. And I just think, in the end, I think there's, to a certain extent, we were just trying to find the formula that we eventually did find. And for that, you need to have made good progress. You needed a good way of articulating externally to a new partner, as in Lithia, the value of Pinewood. One little detail I didn't put you in that summary, which was the smart deal, was that as part of the deal, Lithia and Pinewood then co-invested in a joint venture in the States to roll Pinewood out into the most lucrative SaaS market within the dealer management system ecosystem. And, that in itself helped people understand that it wasn't just a great product, but it was a great product that had a huge and valuable partner in the market that was going to make a difference to the future value. And that is the journey we've subsequently been on as Pinewood Technologies and made some further changes to. But the board just stayed calm. They made sure that, they supported the management and the banks with the fact we were going through the right process. We were talking to the right potential acquirers. So that would be the slightly short version. Obviously, my own personal discomfort was having to be the person that fell on their sword to ensure that Palliser didn't disrupt what was going to be a good process. And the irony, of course, is that both Palliser and our largest shareholder did well out of the deal because their shares obviously accrued some good value. So maybe everybody was happy in the end.
That must have been a deeply stressful experience for you personally.
I wouldn't call it stressful. I would call it inevitably uncomfortable. We all have a degree of pride. So it didn't feel good, but, it's one of those things in life. I at my stage in my career, I wasn't going to lose too much sleep over it. And, I love the business. And as you know from our previous conversation, luckily Pinewood were good enough to ask me to step back into the role post the successful negotiations with Lithia. And I've enjoyed a great period of time under the Pinewood Technologies listing, continuing my chat. But that was clearly not clear as we went through the process. I sort of, as of course, no deal is clear until it's happened. I have to acknowledge that my expectation was that I was going to have to move on sometime during that summer.
So for a board member listening to this who is about to face an activist investor but doesn't yet realize it, what should they be doing now?
Yeah, I think know the value. One lesson I think that probably goes into what I was touching on earlier. Just do know what your breakup value is. I'm not sure all boards genuinely have really tested that, because if there is a breakup value greater than your current value, then be aware that in itself might attract activist investors. And then, you've got some choices there. What do you do about that? And recognize that if that is the case, your strategy has to be able to demonstrate that it can create superior value in a sensible time frame for there to be a reason why you wouldn't do what an activist would want to do. But I think being truly aware as a board as to what the sum of your parts are and what the realism is of being able to separate the parts, which is another bit that, again, that can be quite academic, but the process of separating them sometimes loses the value of the bits too, because there's kind of more codependence between some of the units. But, I think that would be one. Just always check that you've got a strong management team that are genuinely driving good performance. So don't be complacent about that. And I think that's your best defense is know the sum of your parts, know whether you yourself should be divesting of something or restructuring in some way, or doing some M&A to get better synergy with some of your current costs, and be comfortable that your performance is going to keep driving forward as per investors' expectations.
And do you think there are any things that board members can do to maximize the time they have of getting a heads up that an activist investor is coming, or do you always run the risk that you're going to get blindsided?
Well, there's always clues, isn't it? If you are seen to be undervalued in the marketplace, or for whatever reason there is a market sentiment going against your area, then don't be surprised if somebody is going to be looking hungrily at it as an opportunity. So, yeah, if you're performing well in a sector that's kind of at least a little bit loved and momentum's good, then obviously that is a lesser expectation that you should have. But, as soon as for whatever reasons, and life is not fair, is it, as they say, then be wary of your performance not turning into good share price movement. And if you are in an unloved sector, just think how you can demonstrate that you're not going to be hit as much by the bow waves of whatever's going against. So again, if I use an example of that, when Brexit was announced, I was one of many, many retailers who next morning found our share price had crashed by 40%. And that's because the market doesn't differentiate. It says, this is going to be bad for retail, right? All retail stocks bang 40 down. And then everybody then starts investing. Well, what is it that makes us think that? What are the drivers? And do they pertain to every retailer equally? And therefore, again, smart players in that sector are able to demonstrate how maybe they were more protected than other players, or were making themselves more protected to the bow waves that were in theory going to lessen your performance. So again, in any sector, just always look to see whether you are advantaged or whether you are focusing more in an area that makes you less vulnerable to whatever is making stuff tough in your sector.
Ian, time has flown, which means it's time for the lightning round, where I'm going to ask you a short question and ask you for a quick response if you're ready. I think you've already mentioned it, but best book every board member should read, and why?
A book called The Power of Now by Eckhart Tolle. it's kind of a pretty well-known international seller, but it does just all remind us of, in the end, to be effective in all walks of life, you've got to be able to bring your best self to a boardroom, to your business, to your personal life. And I've found that book a great one at sort of leveling, not wallowing what happens in the past, not trying to double guess the future, but being very present in what you're doing during life.
Boardroom behavior that irritates you most?
It's, basically, I have to say most of my boards I've enjoyed having great people around the table, bit of humor. There is the inevitable one, which is all part of our society. People tapping away on their mobiles or their iPad. Quite hard to manage that in the current day. But yeah, we try and have a little of that as possible.
A question every board should ask at least once a year.
I do think you have to go, what is the value of our parts? Has anything changed? Has the external environment changed on us, either the macroeconomics, new competitor threats? Have we got our money tied up in strategies, or are we planning to invest our money in strategies that still are going to deliver the best outcomes going forward? So I think that's definitely worth it, an annual reminder.
What's a boardroom myth you think needs busting?
I don't know whether it's a myth, but I think there's a bit of a swing back that says, this thing about trying to create diverse boards, it should be about getting the best people round the table. And I kind of go back on the football analogy of, well, if that means I've got 11 strikers around the table and I haven't got any midfielders or right backs, apologies for the football analogy. I think a diverse team is the equivalent of a well-balanced football team. And therefore, any sort of swing that says, this is a bit of a myth having thing, I have found that creating diverse teams, whether it's executive teams, management teams, or boards, gives you the best outcome. It just means sometimes you have to work a bit harder at finding the players that tick all the boxes. But yeah, you don't have to lower the standards of the caliber of people around the table in search of getting a diverse board. Sometimes you just have to work a bit longer and harder to get there. It can be sometimes safe if you have experienced hands around the table that people just are not very quick. People can be quite strong on saying, oh, yes, I know where you're going with this strategy, but look, let me tell you about something that happened X years ago. And sometimes that's right, and it's the right challenge, and it's perhaps an insight you hadn't really taken into account. But one of my other favorite phrases is, if you always do what you always did, then don't be surprised if you get what you always got. And often part of what we're trying to do in businesses is nothing is stationary. You're either winning or you're losing. You're never stable. And therefore, often to be winning, you have to challenge the way you're doing things. And therefore, you've got to be careful with people who basically describe the reason why you want to go back to status quo, because status quo rarely works. Might be a version of it, but it rarely works. So sound advice that tries to prevent you from changing the current is rarely right, 100%.
What have you changed your mind on about boards over time, and how has that changed how you behave?
I've been chair of boards now for 12 years. I just think you evolve an understanding of what's really important, I think, as a board, as a chairman, is to really make sure you're getting contributions from all your members, including the quieter ones and the more noisy ones, and then trying to pull out themes. I think another thing that I learned, I was very lucky to be able to observe Sir Nigel Rudd running Boots, and then I obviously worked with Richard Baker. So you're talking about two very high quality chairmen that you're able to learn from. And I think they had quite a nice style of saying, this is not about whether you end up with a 4-3 vote. If you've got a 4-3 situation, I think their instinct would be, okay, there's 3 people that are can still not bought into where we're going, and therefore had the patience to ask the executive team to go away and perhaps, create a little bit more responses to the challenges of those that are not happy. So, yeah, I think I've learned the value of increasingly sweeping the whole of the floor to get all the different inputs, and then checking when some of those inputs don't really get us to true consensus. A bit of patience maybe to try and get more info to enable us to all be more comfortable with the cabinet responsibility you have to have as a eventual outcome.
When was the last time you got a significant judgment call wrong in the boardroom, and what did you learn?
When we were struggling back in Joules, didn't seem wrong at the time, and who knows whether it would have worked. But, what I then subsequently learned, I think tough though it would have been, and that's part of the reason why we didn't go there as a board, but I think that could have been an important step we could have taken there at Joules. I think I learned that just make sure that your banks have the right risk appetite for the model of business that you have was the last bit of the learning from that.
Finally, 3 things our listeners should take away from this episode if they take nothing else.
Yeah, so I'm afraid I'm going to end up summarizing on some of the points that I've said, but take away, how good is that one pager of KPIs? Is that KPI telling you you're on those KPIs? Are they telling you you're definitely on track for this year's business? But more importantly, have you got KPIs that are telling you that you're on track for your development initiatives, such that you're going to be delivering the numbers in your plan in year 2, 3, 4, 5? Second one I think I would do is are you really making sure that all your assets are focused on the future value creations? Is it telling you whether you might need to do M&A to reinforce your strengths, or to divest if you've got money tied up in a business that's never going to return for you? And then the third one, you've heard me talk about it, is, do you know your breakup value as a business? So those would be my 3 pithy ones. If I had a fourth one, I'd say have good non-execs and use them to mentor / advise some of your key executives. That was vying for my top 3.
Ian, thank you so much for taking the time to share your wisdom and experience.
Thank you, Oliver. I've much enjoyed it.
If you want to stay credible and visible as the board landscape evolves, rather than quietly losing ground, the Enter the Boardroom community is built for you. Listeners get 10% off. Visit etb.newroll.com and use the code ENTER at checkout.